Guys, we got to go over 10 stocks that have completely crashed over the past couple of months. But before we do that, get your free money from Moomoo, up to 6 free stocks, each up to $3,500. Just use my link down below, deposit at least $100, and boom, you get your free money. And with that being said, let's talk about these 10 stocks. So to give you guys a little bit of a perspective here, we'll talk quickly about the indexes and see how much those have gone down over the past couple of months, so you can get a little bit of context and be like, okay, the indexes have gone down this much, and then these stocks, which, sorry to spoil it, but they have gone down a lot more than the index. You can compare the two, right? You can see the indexes and then the individual stocks. That's kind of what I'm going for here. So over the past couple of months, SPY has gone down 13% from 480 to about 417. 13%, putting it in correction territory, but not quite yet in bear market territory. Triple Q, on the other hand, and the Russell, both of those are in bear market territory. Triple Q's gone down from 408, now it's at 318. It is down 22%, and we have the Russell down 23% from 2458. That was hit in the beginning of November. Now it's sitting at just about 1900. Again, down about 23%. And we have the Dow Jones, guys, the good old Dow Jones. This one is not even down 10% yet. So it's not even in correction territory, and obviously it's not in bear market territory either. The Dow is now down about 9.5% from the recent all-time high that was hit in the beginning of January. So that's going to give you a little bit of perspective as we're going to talk about the stocks now, which some of which have gone down as much as 80%, which is just unbelievable. And this will show you how risky individual stocks are in the short term and how you could lose a lot of money in the short term as opposed to an index, which again, the Dow's only down 9%, S&P's down 13%. Obviously, if you put money in the indexes, you wouldn't be down nearly as much. So stock number one, and we're going to just bang through these guys because we have 10 stocks to go over in this video, and it's going to be a very short video. So stock number one is Advanced Micro Devices, AMD. And believe it or not, this one's actually holding up the best out of all of these stocks that we're going to talk about in this video. And that goes to show how bad some of these stocks are, because this stock is down from $164 a share, and that was hit in the end of November, and it just hit a low of $85. It is down about 48% during that time period, which is about 5 to 6 months. So AMD is down almost 50%, and with earnings coming up, let's see if something can change, for the stock in terms of, maybe they do good EPS numbers, guidance, revenue, and maybe we get some sort of relief rally, but we'll see. That's in a couple of days here on the 3rd of May, and as of now, again, it's down about 50% from those all-time highs. Netflix is another one. Netflix is down today alone when I'm filming this 4.5%, and overall it is down over 70% from the $700 high that was hit back in November, and now when I'm filming this, it is down, almost down under $200 a share. So just in the past 5-6 months, it has gone from $700 to under $200 a share, which is crazy. Again, about a 70+% drop. And that's because, number one, growth is slowing down tremendously on Netflix. The subscribers, they lost subscribers for the first time in over 10 years, quarter over quarter, and the next quarter that we're in the quarter right now, but when they report this quarter that we're in right now, the numbers are going to be even worse. So Netflix growth is slowing down in a major way. People are flooding out of it, and the company really is just repricing itself. It's setting a new valuation because the growth isn't as good as expected, right? And a lot of growth investors are getting out of this, going to cash, maybe moving money to another stock. You guys know what I mean, right? So Netflix down 70%, over 70%. Shopify is another one which is down about 75%. And this is a pretty easy one, right? We had COVID from 2020, 2021. That's when it was really bad. Everybody was staying home for the most part. The lockdowns, people weren't out and about shopping. shopping as much, and Shopify benefited from this. A lot of stocks benefited from COVID, and it did very freaking well. Shopify went up to $1,700 a share, and it just went on a rampage from the beginning of 2020. It was where was it, 350, and then it went all the way to 1,700. So it went up. We're talking hundreds of percentage points, right? Hundreds of percentage points. And now it's pretty much down, again, 75%. Now it's down to where it was. It's pretty much where it was before COVID. So Shopify, it's repricing itself. The growth is not slowing down per se, but it's just repricing itself because it got way overvalued, during COVID and shortly after 2021 and, earlier this year, right? So it's repricing itself. SoFi is another one. This one's down 80%. This is actually the worst one on the list. If you pull up the 3-year chart on SoFi and look at the all-time high, which was $28, and look at where it is now at $6, it is down almost 80 freaking percent, guys. 80%. And this goes to show, like I mentioned in the beginning of the video, individual stocks are just more risky. At the end of the day, they are more risky than an index, which is why me personally, guys, when I talk to you guys on YouTube, I can't tell you exactly what to do. I'm not a financial advisor, but I talk about what I do, and a lot of money that I have goes to VOO, which is simply an S&P 500 ETF. And honestly, all of us out there should have money in an index, just as, and this is again just my opinion, just as a foundation, to use it as the foundation of the portfolio, because again, S&P is only down 13%, and some other stocks are down way more than that. And if you have that as your staple, your foundation, you can build around it, and during rough times, rocky times like we're seeing right now, you're not going to be as bad, right? So SoFi is down 80%. Coinbase is another one. This one's down about 70%, which is unbelievable. Crypto has kind of been losing steam. It's not losing its core following, the Bitcoin maximalists. I mean, those guys, girls are not going anywhere. But it's kind of been losing steam. Overall, the market, Bitcoin hit an all-time high, I think, over a year ago or right around a year ago, and it's down tremendously year over year. So Coinbase is hurting. On top of that, mostly, I don't want to say mostly because of that, but that's a pretty big reason why Coinbase is hurting right now. So it's down 70%. Palantir is another one, down 75%. I mean, this one did see a bit of a run as we got, the Ukraine-Russia scenario. But now it's pretty much coming down from that, giving back all of those gains. And again, it's down about 75%. And this I don't want to say for sure 100%, but come on, guys, let's be honest. It was pumped by some YouTubers. It did get a lot of YouTube hype initially, which is why you could argue it got to about 45 a share, and now it's down about 75%. So if you still believe in Palantir as much as you did when it was 45 a share, you should be very excited now because it is down 75%. A lot of that hype from YouTube probably died off by now. A lot of those people that held the bag got out, which is thus pushing the stock down lower. And now it's getting much, much closer, and it might even be there now that it's down 7% when I'm filming this video. It's getting much closer to the fair value, most likely, right? And if it gets under $10, that's probably even better. So Palantir, 75% down. Square, don't even get me started, guys. Square is down 65%. We have PayPal. Both of these, we can group them together. Square, PayPal. Square, again, 65%. PayPal's down 73 freaking percent, guys. Unbelievable. And these also did very well during COVID. You can group them in with, Coinbase as well, Shopify, Netflix. A lot of these did very well during COVID. Now they're just repricing themselves, which is why the stocks are coming down so freaking dramatically, right? So aggressively. And, a lot of people don't realize this, but when these stocks shot up so aggressively, we're talking PayPal 300, Netflix 700, even Adobe, when Adobe got to $700, Square got all the way to 300, I believe. Yeah, when these stocks got to that point, they were so ridiculously, just disgustingly overvalued. So we saw that huge push to the one extreme, right? Now we're getting the push to the other extreme, to the point where they're getting just beat to the dirt. They went from being overvalued to the moon, ridiculous prices. Now, I'm not saying they're ridiculously undervalued quite yet. Some probably are, but we're not going to get into that. But what I'm trying to illustrate here is we're just going from one extreme to the other, right? Really overbought, too much green. Now it's just been ridiculous red to the point where these stocks, guys, they've lost 50, 60, 70%, not in 2-3 years. I mean, these stocks have gone down that much in a couple of months. Some stocks have gone down 80%, 70% in 2-3 months. I mean, this is just ridiculous from one extreme to the other. That's all these stocks, a lot of these stocks, right? And another one is Facebook. This one's down 52%, and there is some fundamental things going on with Facebook like Netflix, but Facebook, it's not nearly as bad as Netflix in my opinion, right? We do have monthly active users, that number's slowing down. I think it completely halted, and the whole privacy thing with Apple, the ads, yada yada yada, that is a problem in the short term, but they're still growing more than Netflix, right? More than Netflix. I want to double check that. But I do believe they're growing more than Netflix. And I don't want to just make this a Netflix versus Facebook. I don't even know where I'm going with that. But what I'm trying to say here is it's down a lot, and the PE has come down a lot. And they're still doing pretty well, and I do believe over the next couple of years, they're still going to be growing at a decent rate. So Facebook's one that it's down 50%, and I like it. I own it. I've been buying it. And Snapchat's another one that I like, I own, and I haven't bought more yet, but I do plan on doing it if it comes down from, let's say, 29 where it is now, down to, let's say, 20, 25. That's where I will buy more. But right now, I'm not. I'm holding off, and Snapchat is down 65%. Unbelievable. 60, actually more than that. We're talking almost 70%. So these stocks, guys, again, we're not going to dive too deep into them, but they're down a lot. And there's a lot more that honestly we could talk all day. I mean, we could talk all day about stocks that are down over 50% right now. I wanted to make a video going over overbought stocks that maybe are in due of a sell-off, but honestly, guys, I can't find any. I can't find any. All the stocks that are out there, for the most part, at least that I track, they're all crashing. They've crashed 50, 80%. None of them are really running to the point where they're overbought and due of a sell-off. And that's just where we are. So I'd love to know your thoughts. Drop me a comment, hit the like button, subscribe. We're almost at 25,000 subscribers, and make sure to get your free money from Moomoo. You get up to 6 stocks, each up to $3,500. It's free money. Use that link down below. Deposit at least $100, and boom, you get your money. And with that being said, I'll catch you guys in the next video. Thanks for watching. Peace out.